As of this exact second, SoFi Technologies, ticker symbol SOFI, is trading live at $26.35, showing a robust intraday push of approximately 4.6% in early movement. We are seeing significant volume pouring in right at the opening bell, with the stock oscillating between a low of $25.65 and a high of $26.61 in just the first hour of trading. If you were looking at the pre-market data or the opening flush, you might think this is just standard volatility, but the order flow suggests something far more aggressive is happening beneath the surface. Expectations right now are murky. The general consensus on Wall Street and what you'll hear from the average retail trader in the Discord chats is that SoFi has run too hot, too fast throughout 2025. The narrative is that after breaking the psychological resistance at $25, the stock is due for a massive cooling-off period, a sell-the-news event following the Q3 earnings beat. That is the expectation, exhaustion. But the reality? The reality is that we are witnessing a fundamental repricing of the asset from a speculative fintech play to a legitimate Tier 1 banking institution. The market isn't selling the rip. Institutions are buying the dip with a ferocity we haven't seen since the initial IPO days. We are not seeing a retrenchment, we are seeing accumulation. When you look at the price action on the 15-minute chart right now, you see a classic bull flag forming just under that $26.50 level. This tells us that despite the naysayers calling for a pullback to $22, the buyers are stepping in every time the price creates a micro dip. This is not retail money simply throwing cash at a meme stock. This is structured, algorithmic buying often associated with institutional portfolio rebalancing. The smart money seems to finally be realizing that SoFi isn't just a peer-to-peer lender anymore. It is becoming the Amazon of finance. Let's talk about the specific movement we are seeing today. The stock opened at $25.83, gapped up slightly, and immediately tested liquidity above $26. This level is critical. For the better part of late 2024 and early 2025, the $20 to $22 range was a graveyard where rallies went to die. Breaking through that and sustaining price action above $25 changes the entire technical complexion of the stock. We are no longer in a downtrend or a consolidation phase. We are in price discovery mode. The RSI on the daily chart is hovering around 65, elevated, yes, but not yet in the overbought territory that demands a crash. This suggests there is still room for this leg of the rally to extend toward $28 or even $30 before we see meaningful resistance. Now, pause for a second. I want you to look at your own portfolio. Comment below how many shares of SoFi you currently hold, and more importantly, what your average cost basis is. Are you holding from the $7 lows of 2023, or did you buy the breakout at $20? Let me know, because the disparity in cost basis among shareholders right now is creating a fascinating psychological battle in the order book. To understand why this is happening, we have to look at the broader landscape. You have to compare SoFi not just to itself, but to where the money is flowing in the broader sector. Think about Robinhood stock trading. Robinhood has had a resurgence, yes, but their model is still heavily reliant on transaction volume, options, crypto, the gamified trading revenue. Then you look at Charles Schwab or Fidelity. These are the titans. Fidelity Investments, Fidelity Mutual Funds, and Fidelity Wealth Management represent the old guard. Massive, stable, but slow to innovate on the user experience front. Schwab Intelligent Portfolios attempted to capture the robo-advisor market, and they did well, but it's still a bolt-on feature to a legacy chassis. SoFi sits in a unique Goldilocks zone between these two extremes. It has the user experience and agility of a Robinhood app or SoFi Invest, but it has the banking charter, the deposit base, and the lending economics of a Fidelity brokerage or a regional bank. This dual threat capability is what the market is finally waking up to in late 2025. The stock isn't moving today because of a single press release. It's moving because the multiple expansion is kicking in. Investors are starting to pay more for every dollar of SoFi's earnings because they believe those earnings are higher quality than they were 2 years ago. Let's get into the capital light strategy because this is the engine driving the stock price today. For years, the bear case on SoFi was that it was a balance sheet risk. If the economy soured, SoFi would be left holding billions in bad personal loans. That was the fear. But throughout 2024 and into 2025, management executed a pivot that frankly saved the stock. They shifted to a capital light model where they originate loans and immediately sell them to asset managers, keeping the fee and servicing rights but offloading the credit risk. This is why you see the stock resilient today, even as macro fears linger. They aren't just a bank, they are a loan origination machine. In the most recent earnings report, Q3 2025, the numbers were staggering. We are talking about 12.6 million members. Think about that scale. That is a city larger than New York and Los Angeles combined, all banking on one app. Adjusted net revenue hit nearly $950 million, up 38% year over year. But the metric that really matters, the one that is driving today's intraday price action, is the growth in the technology platform segment, Galileo and Technesis. Most people buying SoFi stocks or SoFi ETFs don't even know what Galileo is. They think they are investing in a student loan company, but Galileo is the back-end infrastructure that powers other fintechs. It's the AWS of the financial world. When you use a neobank or a generic fintech app, there is a high chance SoFi's technology is processing that transaction in the background, taking a toll fee. The growth in this segment proves that SoFi is a tech company, not just a bank. That distinction is worth billions in market cap, and that is why we are seeing the stock trade at these multiples. Contrast this with Interactive Brokers. Interactive Brokers trading is sophisticated. It's for the pros. The Interactive Brokers platform is powerful, but it's complex. Interactive Brokers' fees are low, but the learning curve is high. SoFi isn't trying to beat Interactive Brokers at high-frequency trading. They are trying to capture the high-earner, not-rich-yet demographic. These are people making $150K plus a year who need online investment help, self-investing tools, and investment help all in one place. They want to open the app, see their checking, their crypto, their stocks, and their loans in one dashboard. This financial services productivity loop, or FSPL, is the moat, and today's volume indicates that the market believes the moat is widening. However, we need to address the elephant in the room, the valuation. At $26.35, SoFi is trading at a premium. The expectation from value investors is that this is a trap. They look at Fidelity IRAs or Fidelity ETFs and see stable, boring returns, and they look at SoFi's volatility and get scared. But here is the contrarian take. Traditional valuation metrics like PE ratios are lagging indicators for hypergrowth fintechs. If you waited for Amazon to look cheap on a PE basis, you never would have bought it. You have to look at the rule of 40, the combination of growth rate and profit margin. SoFi is consistently hitting this metric. They aren't just growing, they are growing profitably. The GAAP profitability achieved back in late 2023 was the turning point, but 2025 has been the year of margin expansion. Let's look closer at the SoFi active investing platform versus the competition. SoFi Invest has introduced features that directly target the Robinhood crypto and Robinhood fractional shares user base. But unlike Robinhood, SoFi uses that engagement to cross-sell a mortgage or a personal loan. Robinhood Cash Management is a product, but for SoFi, cash management is the entry point to the entire ecosystem. This cross-buying behavior is incredibly potent. The data shows that a member who joins for SoFi Invest or SoFi Stocks often ends up opening a checking account within 6 months. That reduces the customer acquisition cost significantly. While SoFi Robo-Advisor competes with Schwab Intelligent Portfolios, the integration is tighter. You don't have to log in to a separate portal. It's all fluid. Right now, as we watch the tape, the stock is testing the $26.40 level again. If we break this, the next algorithmic trigger point is likely $27.15. Watch the volume bars on the 5-minute chart. See those green spikes? That's absorption. Sellers are trying to push it down, and buyers are absorbing the supply instantly. This kind of price action usually precedes a squeeze, where short sellers, those betting against the stock, are forced to cover their positions, driving the price even higher. Let's pivot to the macroeconomic backdrop because you cannot analyze a bank stock in a vacuum. We are in late 2025. The Fed has been navigating a tricky landing. Interest rates have stabilized, but they haven't cratered back to zero. This is actually the perfect environment for SoFi. If rates are too high, loan demand dries up. If rates are too low, the net interest margin, the profit they make on lending your deposits, shrinks. We are in the Goldilocks zone, where rates are high enough to generate healthy interest income on deposits, which SoFi uses to fund loans cheaply, but not so high that borrowers default in